Hello everyone, I'm Vincent and this is Resonance Spotlight, the podcast where we explore investment strategies, learn the story behind them and meet the expert who create them. Welcome back to the final installment of our private market mini-series. Saâdeddine Yahia, our expert guest, returns to shed light on NAV Financing, a specialized tool in private market. With his deep expertise in private credit, Saad will explain how NAV loans are unlocking liquidity for investors and reshaping the private market landscape. Saad, it's great to have you back.
Thanks for having me, Vince. Looking forward to this discussion.
Great. So let's start with the basics. So NAV or net asset value financing is not a term that rolls off the tongue for most people. So what exactly is NAV financing and why are private market firms using it more frequently?
Sure. At its core, NAV financing allows private equity firms to borrow against the value of their existing portfolio of investments. The idea is to unlock liquidity without needing to exit from their holdings. So instead of selling assets to raise cash, firms take out loans secured against their portfolio's NAV.
So that sounds like a handy tool for firms that want to keep their investment while also freeing up capital. But why has this strategy gained popularity lately?
Yes, recent market conditions have made it harder for firms to make exits at favorable valuations. NAV financing offers a way to buy time, especially when markets are volatile. It allows firms to weather storms while maintaining flexibility in their portfolios, essentially.
So it sounds like a practical solutions, but I imagine it's not without risk. So what are some of the potential downsides of NAV financing?
That's a critical point, Vincent. The primary risk is over-leverage. Firms might take on too much debt, hoping the portfolio's value will grow enough to repay the loan. But that doesn't always happen. If the portfolio underperforms, they could face a liquidity crunch when the loan matures.
So it's a balancing act. Use the strategy wisely and it's a lifeline, but misuse it and it becomes a financial strain. So would you say there is a tendency to over rely on this tool in the current market?
Absolutely. The temptation to over-leverage is real, especially when firms are under pressure to deliver returns. NAV financing can give a false sense of security if the market outlook is overly optimistic.
So that brings us to the heart of the discussion. Are we seeing firms unlock value through NAV financing, or are they just kicking the can down the road, pushing problems further into the future?
In some cases, firms are genuinely unlocking value, using NAV financing to make accretive investments or manage liquidity effectively. But in others, it's more about deferring the inevitable. When used to prolong the life of underperforming assets, it can create significant risks down the line.
So it's not a one size fits all solutions. It depends on the strategy behind the financing.
Exactly. If the borrowed funds are used wisely, say to shore up strong assets or to invest in high conviction opportunities, NAV financing can be incredibly effective. But if it's used simply to buy time for struggling assets, you might just be postponing larger issues and kicking the can down the road.
Given the risk, what should investors and firms watch for when considering NAV financing? How can they avoid falling into the trap of over leverage?
First, firms need to have a clear understanding of their portfolio's actual value and the risks associated with the underlying assets. Secondly, they should have a well thought out exit strategy or repayment plan. Finally, prudent levels of borrowing are key, taking on only as much debt as can be comfortably serviced, even if market conditions worsen.
It's about knowing when and how to use it then. So what kind of firms or portfolio benefit the most from NAV financing?
Portfolios with stable, cash generating assets that might need a temporary liquidity boost are ideal candidates. Also, firms with strong visibility into future exits and returns can use NAV loans to their advantage without falling into a debt trap.
As we wrap up, Sad, where do you see the future of NAV financing heading? Will it continue to grow in popularity, or will its risk it lead to a pullback?
I believe NAV financing will continue to grow, especially as private markets evolve and traditional exit windows shrink. However, both investors and firms will need to become more sophisticated in how they approach it. The key is using it as part of a broader liquidity management strategy rather than a stopgap measure.
That's great insight, Sad. Thank you for breaking down the complexity of NAV financing and giving us a balanced view of its potential and pitfalls.
My pleasure, Vincent. Always a good discussion.
That's a wrap for today's episode of Resonance Spotlight. I hope you found this deep dive into NAV financing insightful. If you're enjoying our private market mini series, be sure to check out our previous episode on CRT and PIC financing. Until next time, stay informed and keep questioning the markets around you.